The stock market has been sending some mixed signals recently, and as we approach 2025, a perfect storm could be brewing beneath the surface. Rising credit card defaults, mounting interest rates, and growing financial pressures that are clashing with consumer optimism and lofty stock market expectations. On today's Stock Market Brief Show, we're going to be diving into the charts that reveal this widening gap between sentiment and reality. We'll dissect current market conditions, expected moves. We'll get into some crypto and just prepare you with some actionable insights to navigate what lies ahead. Before we hop into today's show, want to thank my patrons that joined. For $9 a month, you can too. You get Discord benefits and a whole bunch of other benefits, including daily, weekly, monthly, quarterly expected moves. You get the entire Trading Ticks auto posting bot suite with the query channel and so much more. I want to thank my partners, Interactive Brokers. If you go ahead and click the link there in the pinned comment, make sure to check out their Interactive Broker Campus because the campus offers up courses from beginner to advanced. It has webinars, podcasts, and so much more. Let's get into today's show. All right, people, welcome back to the show. We got a lot of charts to kind of go through today, but most importantly, I'm going to start off with this meme, which is Will Ferrell in his elf outfit, just waiting for the Santa Claus rally, and it just hasn't shown up yet. Now, I do want to remind everybody that this would be technically, I think, day 2 of the Santa Claus rally, and it goes for the first 2 trading days. It goes till the first 2 trading days of January. I think that's important to know because we've already reached into an important level for the week. On my last video, we talked about a critical level that we hit, and we started to see the markets kind of pull back a bit. Well, now we're at another critical juncture point, which we'll dive into as the show progresses. Now, before we get into that, I just want to go over some really interesting charts because if you look around, many times things look good all on around. We're hearing good news about certain things, but I want to kind of break down some stuff that I just found to be interesting that really shows more struggle than anything. I'm going to start off here. This is from the New York Fed. It's the credit card limit and balance for credit cards. And I want to call out just a couple of colors here. The darker, which is the credit card balances, they've been rising slightly over here, as you can see. The amount that they can use on their credit card limits has been drastically increasing over each quarter here. Now, this is important to me because what I'm starting to see here, and other people are as well, is that U.S. credit card defaults are jumping to the highest level that we haven't seen since, well, 2010. The subheading here is saying that they're tapped out after years of high inflation and as a pandemic era savings had evaporated. You can look at homelessness in America, and this saw a massive jump from the prior year in 2023. If you take a look at transitions into delinquency by various loan types, you'll see that we have credit card loans that have been on the rise, so meaning that there's 30-day plus delinquencies here. Auto loans, those have been on the rise. One thing that I've been keeping an eye on here is student loan. There's been student loan forgiveness. So you saw this big drop off here. So if this starts to make waves and start to creep back up, I think that this could kind of accelerate some of the other things that we have been noticing. If you look into 90-day delinquencies, which are considered serious delinquencies, you can see credit cards over here saw a pretty large move. The auto loans is not as bad, but they have been creeping up. Even mortgage rates have been slowly on the grind higher here too as well. Not mortgage rates, but mortgage payments there. Now, if we take a look at the interest that consumers need to pay on, for example, credit cards, which we're seeing a large default on, look at, I mean, it's as high as it's been for dating back to 96, maybe even further. This is just the data I have going back to 95. We're talking 21, 22% interest rates on credit cards, which is incredibly high. So if you're thinking how you can avoid this type of stuff, that would be the number one focus here to prepare yourself if something bigger were to come, is to make sure that you do not have this type of consumer debt, because it can really become a big burden. If you look at the interest rate on 72-month loans for auto loans, those are also floating around 9%. That's 72 months. You can look at other variations of this. I just pulled the 72 because as things are getting more pricier, people look to longer term loans to reduce the cost of a monthly payment. Now, as unfortunate that is what we are seeing here. And then the interest rates are still creeping higher to time what we haven't seen since 2016. That's as far as this data goes back. The average car that's new, which is financed, is just in and around $40,000. So that's the average amount financed for a new car. For a used car, it's around 24,000. And if they're buying a new car with putting $1,000 down here with some quick math, their monthly payment on an interest rate around this is going to be around $750 a month, and they're going to be paying about 20% interest over the course of that loan. That's just some rough math on the top of my head. You'd have to double check, but I also found this to be kind of interesting here, but net percentage of domestic banks increasing the minimum required for down payments. Now, this is funny because how do you read this? Well, it's at 0, right? So if they were asking for higher down payments, this line would obviously go up. But what's the problem here? Why wouldn't they be asking for higher down payments here? Well, because that would probably make sales a lot worse if they're requiring a higher down payment that the consumer simply just does not have right now. If you look at the unemployment rate, just since last year, we have been seeing a series of higher lows building in the unemployment rate. But if you do scale this out a lot of bit to the 90s, it's still relatively low looking back through history. The personal savings rate is also really low looking back through history as well. If you take a look at the 30-year fixed mortgage rate, so how are consumers faring with the higher interest rates to buy a home? Well, interest rates are relatively, very high, since the highest that they've been really since in around 2007, going into 2008, roughly at 6.85% right now for a 30-year. And you'd think that with higher interest rates, I'm fine with higher interest rates, but I would prefer higher interest rates with lower priced homes. But if you look at the median sales of homes sold in the United States right now, from based off of Q3 2024 data, it's 420,000. So that has came off ever so slightly, but dating back just right to the pandemic, it was a lot lower, roughly at around 300,000, slightly above it, and it's made a quite the big increase in recent trades. This article, sorry, not recent trade, but just recent whatever years. This article I found to be interesting. This was published back in August, going into September. And this had to do with the Dollar General, which is a discount retailer. And it was the CEO talking, saying that he spotted a trend that does point to struggling consumers. And this was some interesting insight. So I dug that up. And they noticed that the 3 softest weeks for the second quarter, when you're looking at comparable store sales, were the last 3 weeks of each month. So what they were suggesting was that the consumers are less able to stretch their budgets through the end of the month. So they believe that a softer than anticipated sales performance in Q2 is at least partially attributable to that core customer that is less confident of their financial position. If you just look at this chart tells a magnificent story, right? Walmart is the discount retailer. I forget their saying, but it is the discount retailer. And Target is, in my opinion, and probably many others, it's more of a premium retailer. They got some nicer things, better displays, typically higher prices in a lot of different categories from what I've noticed. And just look at their performance in 2024. Target has getting slammed. Well, it's flat for the year, but it's down for the year, while Walmart is up 75%, right? It's coming off a little bit in recent trade. It's one of the top performers in the S&P 500, and it's a consumer staple. This is just beyond interesting environment. This chart right here really does paint a good picture, and this is one that I posted on X, and it's talking about collections, right? If you have credit card debt and you don't pay it and it gets pulled into collections, right? The third party buys that debt out and then you have to pay them. That's what this is showing, okay? But what I find interesting here is that the percent of consumers that have collections is less, right? So cool, less people are in collections. But the average collection amount for people that are in collections has skyrocketed. So what does that tell you? It tells you that the people that are struggling more and more in this current context and in this current economy. If we continue on and look at stuff like inflation rate, yeah, inflation has came down a bit, but in recent, right, if we're looking at the year-over-year United States inflation rate, this is not core, right? This is the inflation rate. This includes food and energy, right, has been actually seeing subtle upticks in recent months. And this last report we saw natural gas prices rise, and we saw inflation accelerated in food. And when you really think about the food, the consumer, well, it costs more now to heat their home, right? Going into the winter season. And then on top of that, food's more expensive. So you get the double whammy hitting to you as a consumer. If we just pull up a chart of nat gas, a couple of video ago, we talked about natural gas, and it just hit a new year high just recently today, right? It was up 15% on the trading session. So if natural gas is starting to break out here and move higher, I mean, that's going to accelerate pressure for the people that rely on such an important commodity. Now, while this is all happening, what I find very interesting is that consumers are still expecting stock prices to rise over the next 12 months. And this is the highest it's been, well, in history. So more people are involved in the markets. More people want to see higher. And this is where the disconnect is. You can visually see that there's more struggle taking place, but then you can visually see that there's more optimism. Or is this optimism getting confused with hope a little bit? Well, if we do break down for another chart here, this is record equity exposure. So it's showing that U.S. households have a record 43.4% of their financial assets in equities. Furthermore, that might be yet another contrarian signal that investors are currently too bullish. Maybe not, right? I want to finish off some of these charts with this bigger picture chart before we hop into the conditions of the market, the S&P 500 and so forth. This is one that I share very frequently because it's very easy to read and very easy to really just get a grasp of multiple aspects of the market. You have the S&P 500 up here. You got the 10-year, 3-month Fed staple. That's the yield curve. And then you got the federal funds rate, right? If you don't know what all these are, that's okay. In short, like, that's why I like visuals, right? In the federal funds rate, when things are priced, when it's really low, right? When the federal funds rate low, what does this encourage people do? It encourages people to spend more money, right? Money is cheap, so you can get more and more and pay less and less. A quote, I'm using quotes on my finger. I know you can't see me. Now, when money becomes more expensive, when it creeps up higher, what does that encourage? It encourages people to save and get out of more riskier type assets. For example, when the federal funds rate was up here, I mean, you can have your money in a money market account making 4, maybe 5%. And that's pretty darn good when you look through history in the S&P 500 from a historic basis, 9% a year, right? On average, you can do that with close to no risk whatsoever. Right now, the S&P 500 is clearly up more than that 5% for this last year. But you get my point of what I'm trying to say here. Now, if we put this all together, what do you see? Well, the 10-year, 3-month is beginning to uninvert. Now, the yield curve, when it inverts, it's a good predictor of a recession to come in the future. And when it uninverts, what we've seen in the past is that it typically 6 months to 18 months-ish around these areas, you typically run into some sort of recession, which is really creating that perfect storm scenario that we can be having some hard times in 2025. It doesn't necessarily mean that the market has to crash, but it could very well become more of a stock picker's market where you're dealing with a lot more fluctuations that you may be not used to. Because, I mean, these last couple of years, they've been easy. And I'm not just saying that to say that. We just had back-to-back 20% gains, right? Year in 2024 and in 2023. The last time that has happened was over here in 97 and 98. Then we went up a little, had another good year. It was almost 20%. And then we led into the dot-com bubble bursting. Okay. And what you'll notice here is we start to steepen and the Fed starts to go through a rate cut cycle. You've noticed through history, that's not always a good thing. And a lot of people have said, well, we're at all-time highs. It's different. And then I go back to this. I'm like, yeah, well, we were at all-time highs here in 2000. We're at all-time highs here in 2007, late 2007. We were at all-time highs going right before the pandemic. And all these same things were really occurring in alignment. So it's not a predictor. It's really just to give you some insight that, hey, people are struggling. The market is, there's definitely some signs here, but we're still seeing some positive strength if you look at some of these bigger picture charts. Let's go into the S&P 500 and kind of dive into that. So the S&P 500, this is the weekly chart, right? So what are we doing? We're seeing a couple of weeks down. We've seen a couple of weeks down here. We saw a couple of weeks down here, right? Once we're below the weekly 5 EMA and it's declining, it's a time to be a little bit more cautious. So it would be much more beneficial, right? It'd look a lot better if we start getting back above 5950 and starting getting back into the 6,000 range to head higher. And we're just not right there at the current moment. Now, when we get very extended from these weekly 5 EMAs, it's very common to see snapbacks. So that's what we saw. That's what we talked about when we were down here. It was like December 18th. We talked about the rubber band effect. And when we see more volatility pick up to the downside, it's likely to see more volatility pick back up to the upside. And you can see that here in August where we saw a snap to the downside, we rubber banded up. We rubber banded down, we rubber band up. Okay, it's just this interesting thing that takes place in the markets. Now, if we look at something like the 5, 10, 20 timer, it's where you take the 5, the 10, and the 20 EMAs and you put them on your chart and you want them to be stacked up like so, right? You want the 5 here, the 10 there, and the 20 there. That's bullish. But if it's bearish, if it looks like this, where you have the 5, right? Well, if you just stack it differently, you have the 5 down here, you have the 10 down here, and then you have the 20 over here. And that's what you see over here, the blue below the red, below the green, and the market was heading down. It wasn't until it started correcting and getting back to produce a little bit more of a bullish trend. And right now in this current context, the 5 is declining, the 10 is declining, the 20 is flat to declining, and they're all stacked against each other. That doesn't mean we can't bounce up. And it doesn't mean that Santa can't show up here late into the 4th inning of the Santa Claus rally. But just note that this is a subtle change taking place. Now, while this is taking place, we're also already extended to the downside on the RSI and the bullish percent index for the S&P 500. And we haven't been this low of a reading, right? We just hit 39.8%. We haven't seen this low of a reading since November of 2023, and that led to this bullish divergence taking place and eventually catching quite the fury to the upside in the markets, kind of coming out of a 10% correction or so. The same thing with the NYSE bullish percent index. We're at 45 reading. Haven't seen that for quite some time there too as well. And the RSI is getting a little frothy here. I personally like to see positive divergences form, like something like this, right? And we're not quite there yet because oversold can stay oversold, right? It doesn't necessarily mean just buy right away. But I'm calling this out because today, right, we saw some these last 2 days, we saw some price action to the downside. We're getting a little frothy readings. We're underneath the weekly 5 EMA that's frequently tagged. And you can see snapbacks to this type of stuff. We'll talk more about that into the market conditions. If we look at the percent of stocks above the 50-day moving average, 20% of the stocks in the S&P 500 are above the 50-day moving average. Another way to say that, 80% roughly, right, we're rounding here, 80% of the stocks are below it. So that's a large portion of the S&P 500. Now, whether that 50-day moving average, the price is below it, is it inclining or declining? I don't know, right? I'd have to go through every stock and kind of look to see which one has an inclining 50-day or declining. So if it's inclining and price is below it, I'm not all too worried about that, really, to be quite honest, and that would be some important data. But if it is starting to flatten out and decline, well, that could tell us that that medium-term trend is definitely changing, and that can have an effect on the markets, right? You can see here, right, the market kept pressing higher and higher, but the percent of stocks kept on kind of falling off, which creates that poor breadth divergence. And then we started to kind of break down. And when we start getting into this 10%, that's a pretty darn low reading. And that's where you really want to pay close attention because you can see some snapbacks in many names. You can look for divergences, right? You had a low here, you had a lower low. Take a look here. You had the breadth reading of around 10%. You had a low, but you had a higher low. So what does that tell you? Back here in September to November 2023, going through that correction, it told us that actually now, as the market was pressing lower, the internals of the market were actually strengthening subtly there. And that right there could have gave some insight to a nice move out of this correction that we did go through. So these are all things that we can pay attention to going into 2025. Remember, it's very common to see a 5%, 10% pullback multiple times in a trading year. If you look at the percent of stocks above the 20-day moving average across multiple assets, we'll take a look down here at the S&P 500. It's at 9.6. So that means 9.6% of the stocks in the S&P 500 are above their 20-day. So this is a pretty extended reading here. Extended reading in small caps, mid caps, the 1500, the 100, which is the largest market cap names in the S&P 500. Dow Jones is not quite extended as much, but it's still at a relatively low reading. The Nasdaq 100, same story. The NYSE, it's right about there. Nasdaq is faring more well, as it's rather broad market there with a lot of different names. So let's hop into the conditions of the market. What's changing here? And I look at two things. I look at the gamma flip line, and I look at the directions of these 5-day moving averages. Not whether really price is above it or below it for the most part, but whether the direction is trending down or trending up. So we are below the gamma flip line, which is roughly at 59.60 in this current context. I'm sure it's going to be updating a little bit tomorrow, but it's roughly at about 59.60 at this current context. And what does this mean? It means that dealers, they sell into selling, they buy into buying. Volatility typically gets increased as we're in a negative gamma regime. Now, we're so close to it, and we've been kind of close to it, so it's a rather more neutral. They do tend to act like a zone, but just understand that when you're below the gamma flip line, this is where you can see massive moves to the upside, massive moves to the downside. It's very common. We're barely hanging on to the put wall here at 5,900. There's a lot of exposure there. So yeah, I'd be more confident if we can hold 5,900 and then eventually get through that gamma flip line. But if we start breaking down from these levels, watch for 5,850, and that would be kind of retesting the recent lows in the S&P 500. Now, the direction of the 5-day moving average across the board here, the SPY, the Q, the IWM, semiconductors, you can look at biotech and even Dow Jones Industrial Average, they're all pretty much red other than semiconductors. Semiconductors is yellow, but I mean, if we stay down here any longer, that'll flip red because the calculation will start bringing the average to the downside. And they're all below their anchored volume weighted average price from the December swing low in this context. So the market is telling us right now, be patient, let the market prove itself before you kind of just blindly enter in and try to get aggressive. Now, the aggressiveness, it could come in. And by the way, tomorrow's the last trading day of the quarter, last trading day of the year, right? You can get some month-end markup, or you can get some crazy rebalance stuff going on where you get some more volatility in the markets. But just know that if you are entering into the market and the market hasn't proved itself by getting in the proper conditions, just position yourself as far as sizing goes more to be able to withstand more volatility. Let's go to the expected moves. I started this episode off talking about how we talked about the rubber band effect too, that we've came into a critical level. And that critical level, day one, within the first minute or two, basically, right? We opened there. Of the market open for the week, we came already down to its implied move for the week. Now, this is crazy because this is day one of the week. It's a shortened trading week, and the week was still an $8.40 expected move on the SPY, which is roughly an $85 expected move on SPX. Now, as we're down into this range, we also came back down close to this month-to-date level as well, which is the expected move for the month, which we got going into the end of December. Now, if you want the new updated monthly expected moves, I'm sure I'll probably share them here at some point. Same with the quarter, but I will be posting those January 1st in the Discord group with new month to dates, quarter dates on a lot of different products, okay? So right now, we've already came into the lower weekly expected move. So the market's in its happy place at the current moment. You can see today we got underneath that implied move. Okay, we did a little bit of a U-turn, saw a little bit of a move back, and we kind of came back down into the week-to-date anchored volume weighted average price. From what I've noticed is when we come to these lower weekly moves or the upper weekly moves, price typically kind of just doodles around. It's very common to see that. Now, coming into month end, quarter end, it's kind of an open book here. I think you just got to be patient and very, very confident in your sizing of your positions, knowing that we're in that negative gamma regime, that we're below some of these declining 5-day moving averages. Now, if we were to break down through this weekly expected move, just be very careful when you start breaking through these lows down here on an intraday time frame, because what happens is you'll visually see it on your screen. If you're looking at a minute time frame, if you're intraday trading, all right, this is for the intraday traders. If you're looking at volume and all of a sudden you just see this explosive move in volume, that right there would be some dynamic hedging taking place. You can look at like ES, for example, and if it breaks those lows and you see some explosive volume, that you can 7,000 to 9,000 contracts in a minute. Just be very careful if that were to take place, because it could be telling us that we're seeing the dynamic hedging really kick in and come outside of that weekly expected move. Now, if we start breaking down here, we do have some lower levels to pay attention to. That's their daily implied move. We have that down roughly at pretty much the monthly lower implied move too. So any moves through here, right, the higher probability is that we trade back into the upper weekly expected move. And I say this because that is probabilities. You can see that we typically tag the weekly expected moves. These are weeks dating back to October-ish. Okay. And you can see we tag it and we close within it, tag it, close within it. Every once in a while, you break through it, right? There's some news. This was the president, not the inauguration, but the election results. And then you see some more volatility here, even over here, right? This was the Fed. Okay, so sometimes events create more volatility that the market didn't quite anticipate perfectly, but these are the levels to know. Last week, right, we tagged into the upper weekly expected move, and then we came right back off. That was that critical level, and this is the critical level now that we are holding on to. Now, if you want the daily implied moves going into tomorrow's trading session, this is a sneak peek here of what I kind of share daily on the Discord. This is the daily implied move for SPX. We have ES, NQ, Ruddy, Spike, Q, IWM, and then I have the upper level, lower level, and then the 2 sigma levels too. And I bring up the 2 sigma levels because, right, if you think of it in terms of a distribution curve, right, you have 68% of the time it closes within the daily implied move, but then you have 2 standard deviations, right? And those, right, 95% of the time it'll close within those. And when things get really volatile, like they did on this trading session over here on Friday, the Qs actually had a 3 sigma move. And to close outside of a 3 standard deviation move, we're talking less than 1%. And as soon as price got down there, I just kind of take my stab and I'll do an intraday trade to see if it goes back up to more like the 2 standard deviation move. So that played out very well. But those are sometimes when you see like just massive, massive moves, if these levels, you can play based off of probabilities and feel a little bit more confident going into that. And if you're wrong, well, when you would be wrong with that by position sizing, if you're just going to do a measured move, or sorry, a daily EM length, or playing it back into the 2 sigma move, but those are more rare, but I do like playing those if they do happen. Crypto, I want to hop into this. The sailor to shift tool did hit a sell signal last week, and then it got the trigger this week. It did cross underneath the prior trading week, so it's officially there. Now we're coming into, like I said, the end of the year. All right, we'll see if this plays out or if it's just a whipsaw. I couldn't tell you. I respect the signal. I respect the trigger. I'm hoping that it turns right back around, to be quite honest. I would like to see crypto to kind of take off into the new year, into the new administration, see what that looks like. But right now, sell signal, sell trigger. We'll see if it whipsaws and go back to trying to get back in. If I just look at the chart of crypto, yeah, this negative divergence that was forming, it's still the relative strength ratio is still above the 50 EMA. It kind of looks a little toppy here, potentially head and shoulders, not much volume traded underneath this. I just give it some time, see if it can heal, see if it could set back up. If something actually does set up nicely, but we don't get a signal, I don't mind trading it. But as it stands in this current context, the trigger came, we saw a little bit stronger of a flush, rebounded slightly intraday, and that's all I got for you on today's trading session or on this today's stock market brief show. Everybody, hope it helped out.